Hello dear viewers, welcome to our channel. Today we are excited to delve into the world of investments and share some valuable lessons that can boost your investment strategies. In this video, we will explore the book One Up on Wall Street and get to know its author, Peter Lynch. Topic 1. Who is Peter Lynch? Peter Lynch is one of the most iconic figures in the world of investments. His brilliant career and remarkable achievements make him a reference for investors of all ages. Throughout his journey, Lynch has left an indelible mark on the financial market, and his name resonates throughout the investment sector. Lynch is best known for his management of the Fidelity Magellan Fund, one of the largest and most successful mutual funds in history. His exemplary leadership has led the fund to achieve extraordinary returns, consistently outperforming the market and its peers. Under Lynch's management, the Fidelity Magellan Fund achieved impressive growth rates, making him one of the most admired fund managers. His unique approach and his ability to identify valuable investment opportunities have brought benefits not only to the fund's investors, but also to people seeking solid guidance in the world of investments. In this video, we will explore Peter Lynch's investment philosophy and the lessons we can learn from his experiences. Stay with us to discover how he managed to stand out on Wall Street and how his strategies can help boost your own investments. Don't forget to subscribe to our channel for more valuable content on finance and investments. Let's get started. Topic 2. Peter Lynch's investment philosophy. Peter Lynch, a famous fund manager and the author of the book One Up on Wall Street, is known for his unique investment philosophy. His approach is centered on sound and practical principles that can be applied by investors of all levels of experience. Let's explore some of the key aspects of his philosophy. Invest in what you know and understand. One of the cornerstones of Lynch's strategy is the principle of investing only in what you know and understand. He argues that many investors go astray by trying to invest in sectors and companies beyond their comprehension. Instead, he encourages identifying investment opportunities in companies whose operations you understand well. Invest in companies, not just stocks. Lynch is known for his emphasis on investing in the potential of the companies themselves, rather than solely focusing on stock price movements. He believes that investors should analyze the fundamentals of the companies, such as their financial health, growth prospects, and competitive advantages. By doing so, investors can make more informed, long-term decisions. Topic 3. Lynch's investment cycle. Lynch described a fundamental concept in his book, the investment cycle, which comprises of 4 distinct phases: research, growth, maturity, and decline. Let's understand each phase in detail. Research. This is the initial phase of the cycle, where investors are in the process of discovering promising companies. It's a stage of in-depth analysis, market research, and identification of emerging trends. Growth. In this phase, companies that were previously identified enter a period of rapid growth. Investors can reap significant rewards as these companies thrive. Maturity. After initial growth, companies eventually reach a point of stability. At this stage, investors can continue to receive consistent dividends, but the potential for explosive growth diminishes. Decline. Finally, some companies enter the decline phase, where their business weakens due to various factors. At this point, investors may consider selling their shares. To successfully apply Lynch's strategy, it is crucial to identify in which phase of the cycle a company is. This allows investors to make informed decisions about when to buy, hold, or sell shares of a specific company. Topic 4. Finding investment opportunities. Finding investment opportunities is a crucial part of success in the financial world. Peter Lynch, in his book One Up on Wall Street, shares some valuable tips on how to identify promising stocks. Tips on how to find promising stocks. Stay informed. Stay alert to news and events that may impact companies and sectors. Monitor economic trends and factors affecting financial markets. Do your research. Fundamental analysis is key. Study a company's fundamentals, including its financial health, performance history, and growth prospects. Balance sheet analysis. Examining financial reports is an essential step. Evaluate key indicators such as net profit, revenue, profit margins, and debt. This will provide a clear view of the company's financial stability. Financial ratios. In addition to balance sheets, consider financial ratios like P over E, price over earnings, and PEG, price over earnings to growth. They can help determine if a stock is overvalued or undervalued. Qualitative factors. Don't limit yourself to numbers. Consider qualitative factors like management quality, the company's competitive position, and its innovation. Diversification. Don't put all your eggs in one basket. Diversifying your portfolio can reduce risk as you're not solely dependent on the performance of a single stock. Topic 5. Avoiding common pitfalls. Avoiding pitfalls is as important as finding opportunities. Peter Lynch warns investors about some of the most common traps and provides guidance on how to escape them. Identification of common pitfalls. Speculation. Avoid the temptation to speculate in stocks based on rumors, hot tips, or market fads. Speculation can lead to significant losses. Fad-based investment. What's popular today may not be tomorrow. Avoid investing in companies solely because they are trendy. Long-term success is built on solid fundamentals. Patience. Don't become impatient and expect immediate results. Successful investing often requires patience and a long-term mindset. Constantly monitoring the market can lead to impulsive decisions. Herd mentality. Don't blindly follow what everyone else is doing. Making investment decisions based on conventional wisdom can be risky. Trust your own research and judgment. By avoiding these common pitfalls and adhering to a strategy grounded in solid analysis and long-term goals, you'll be better prepared to navigate the complex world of investments and achieve more consistent and sustainable results. Patience and discipline are key, and following Peter Lynch's lessons can be a valuable guide on this journey. Topic 6. Diversification and risk management. Portfolio diversification is a cornerstone of Peter Lynch's investment philosophy. He understands that by spreading your investments across a variety of assets, you can reduce portfolio risk and balance the risk-reward relationship. Here are some key concepts on this topic. Explanation of portfolio diversification and how it reduces risk. Diversification involves investing in different types of assets, such as stocks, bonds, real estate, and even alternative asset classes. The goal is to reduce the overall risk of the portfolio, as different assets behave differently under various market conditions. While one asset may be declining, another may be on the rise, balancing the overall portfolio performance. Approach to balancing risk and reward in investment. Peter Lynch emphasizes that while diversification is essential for reducing risk, it is also important to find the right balance between risk and reward. This means that when diversifying, you should not completely sacrifice the potential for returns. Low-risk investments often generate lower returns. while high-risk investments have the potential for higher returns. Finding a balance that aligns with your financial goals is crucial. Practical suggestions for risk management in investments. Set clear investment goals. Determine your investment objectives, timeframes, and risk tolerance. Diversify properly. Spread your money across different types of assets and sectors. Rebalance regularly. Adjust your portfolio according to changes in market conditions to maintain diversification. Maintain an emergency fund. Have an emergency fund to cover unexpected expenses so that you don't have to sell investments during downturns. Conduct ongoing analysis. Monitor the performance of your assets and make adjustments as necessary based on your goals and market conditions. Topic 7. Additional lessons from the book. In addition to the topics discussed so far, the book One Up on Wall Street offers many other valuable lessons for investors. Some of these lessons include: understand the company before investing. It's not just about numbers. Understanding the company's mission, products, and services is crucial. Don't be afraid of volatility. The market is volatile, and short-term fluctuations are common. Have confidence in your research and long-term strategy. Learn from your mistakes. Investment is not free from errors. Learning from failures is an important part of growing as an investor. Maintain a long-term investment horizon. Avoid the temptation to buy and sell too frequently. Success often comes to those who have patience. Conclusion. Throughout this video, we have explored valuable lessons and insights on investments based on Peter Lynch's book, One Up on Wall Street. To summarize what we've learned, Peter Lynch's investment philosophy emphasizes the importance of investing in what you know and understand, as well as focusing on companies rather than just stocks. The investment cycle, with its phases of research, growth, maturity, and decline, provides a solid framework for understanding company development. Finding investment opportunities requires research, fundamental analysis, and consideration of financial indicators and qualitative factors. Avoiding common pitfalls, such as speculation and trend-based investment, is crucial for long-term success. Diversifying the portfolio helps reduce risk, but it's important to balance risk and reward according to your goals. In addition, the book offers a range of other valuable lessons that can enrich your approach to investment. Encouragement to read and apply. This video was just an introduction to the lessons offered by Peter Lynch in his book. For a deeper and richer understanding, we encourage all viewers to read One Up on Wall Street. The book provides detailed examples, inspiring stories, and practical guidance that can transform how you approach investment. Apply the lessons learned to your own investment strategies. Remember that investment is an ongoing journey, and learning and improvement are fundamental to success. We thank you, our valuable viewers, for dedicating your time to this video. We hope you found the information helpful and inspiring. If you enjoyed the content, don't forget to subscribe to our channel for more informative videos on finance and investments. We invite all of you to share your opinions, questions, and experiences in the comments below. We would love to hear your perspective and engage in constructive discussions on this important topic. Until the next video, happy investing!